It is Steve Papelli here again. Today is March 19th, 2013. And no, you're not having some sort of flashback. This is a redo of a webinar that I did actually 1 week ago. 1 week ago and 1 hour ago. Actually 1 week, 1 day, and 1 hour ago. 111. We're going to talk about option calisthenics again. Okay, and we went through this a while ago about early exercise calls and puts. I think there might have been a little bit of confusion with that, so what I thought I'd do is try to represent this a little clear, hopefully, and maybe we'll get the message through a little bit more. So let me get started here. And a lot of this is familiar. This is almost virtually the same webinar. I did make some changes in some of the text here and some of the examples you'll see, but we are Army training again. And again, the legal disclaimers. I am a registered investment advisor. This is all for informational purposes, both as representative of PLE Capital and Discover Options. All right, we're going to go over these things today. We're going to review exercise versus assignment, American versus European, some of the factors, and there's two main factors that really determine early exercise. We will cover synthetics, and I'll explain why we talk about synthetics here when we're dealing with early exercise when we get there. And we'll hit an example or two, and we'll kind of wrap it up there. Okay. Exercise or assignment. Exercise or assignment. It's really the same coin, just two different sides of that coin. If I am the holder of the option, the owner of the option, the buyer of the option, I have the right to exercise my option. Okay? And again, it is a right to the owner. Okay? The seller has the obligation, and he is what we call being assigned. Okay, so there's two parties to the transaction. There's the buyer, there's the seller. The buyer has the right, and he exercises. The seller has the obligation, and he is assigned. Okay, probably review for most of you. We sort of use the terms interchangeably here, exercise and assignment. I just want to make sure we're clear on what it exactly means and which side of the transaction we might be on. American versus European options. American options can be exercised before the expiration date. Okay, OEX is an example of American option. Virtually all of the equity options are American options. So what that means is, from a practical purpose, is if you're an owner of an option, you have the right to exercise your option anytime from the point that you buy that option up till expiration when it goes away. Now, it may not make economic sense to do that, and we're going to kind of go into that a little bit here, but purely from a right perspective, you can exercise an American option any day you want, basically. In contrast, we have European options, and the European options can only be exercised on the expiration date. Okay, an example of a European option is the SPX, which is a very popular index option. I know a lot of students, a lot of traders use SPX. XEO, which is the European version of the OEX, less popular, but it's still out. It's out there. It was actually, I think it was put out there. It's only about 5 years old, I think, maybe a little bit more. The RUT, NDX, again, European options. These are, I think, becoming somewhat more popular, especially when you're dealing with institutions and funds and things like that, where they don't want to worry about early exercise. A lot of the hedgers, portfolio hedgers, when they hedge their positions, if they happen to have calls that go in the money, for example, a lot of times they don't want to worry about early exercise. So the European options are very popular with a lot of the funds. All right, the determining factors when we're dealing with early exercise, there's really two main things that come into play when we're trying to predict early exercise. interest rates and dividends. These are really the two main things that are going to drive when we exercise our options. Okay, and we're going to take them one by one here. First, let's remember that options are a levering instrument. Okay, they're really a substitute for, in this case, a stock, but any underlying that they're tied to, the option is really acting as a substitute for that. So as interest rates go up, calls tend to go up. The reason being is because calls allow us to purchase stock for a lot less money. They create leverage. And if interest rates get higher, our borrowing costs go up. Therefore, it's more advantageous or more attractive for us to look at the call because it allows us to control the same number of shares for a lot less money. And if we have a lot less money out there, obviously our borrowing costs are going to be, our out-of-pocket borrowing costs are going to be lower. So rates go up, calls go down. Rates go up, rates go up, calls go up. Rates go up, puts go down. Rates go up, puts go down. And again, this is due to what we call the short stock effect. And what I mean by the short stock effect is puts are really again, a substitute for being short the stock. So if we didn't buy the put, if instead we shorted the stock, theoretically, we would receive cash. If we were to sell stock to somebody else, they would pay us cash. We would then theoretically put cash into our account. That cash would theoretically earn interest. And I use a lot of theoretical here because a lot of this isn't happening in retail accounts. And even today with interest rates so low, it's sort of a moot point. But nonetheless, this is the analytics that you want to look at when you're trying to determine early exercise. So when interest rates are high and we have cash in our account and we're earning interest on that, that's a good thing for us. So higher interest rates, we'd probably rather have all that cash sitting in our account to collect interest than go ahead and buy a put. So rates up, puts down. Okay. Okay. Now, why interest rates affect options? Again, options are a substitute for stock, and that's what we want to try to remember here. Always think in terms of borrowing cost. Okay, borrowing cost, and we call this in the I guess as traders we refer to this as cost of carry. Okay, and our cost of carry is really just, again, the interest that we have to pay to either put on a position, to pay for the stock or whatever, or the interest that we receive. Okay, but that money that we pay or that we receive, we call it cost of carry. So I'll use that term cost of carry back and forth between that and interest. Okay, and here's the kicker though. Keep this in mind. Even if you have your own cash that you can go out and buy the stock, and you're saying, oh, gee, you know what? I don't need to borrow money because I have it's sitting in my bank account. Doesn't matter. Whenever you evaluate early exercise, or whenever we evaluate trades in general, we always want to think in terms of what it's going to cost to borrow or finance. Okay, just like if you're going to go out and buy a car, part of the decision process is interest rates. Even if you have the cash yourself and you're not going to finance it, the price of that car is going to partially, in the terms of that car, is partially going to be determined by interest rates. Same thing in the options market. Okay. So again, when either buying or selling a stock, there's cash to be paid out in the case of buying the stock, and there's cash taken in the case when we sell the stock. Okay, that's going to play into the whole decision-making process. The second factor in early exercise, and we're going to delve into each one of these in a little more detail here in a sec, are dividends. Okay, dividends tend to lower a stock by the amount of the dividend that's paid out. Okay, on the ex-dividend day. So if we've got a 25-cent dividend, the stock will drop by 25 cents the day that that dividend is paid to holders of record, which is ex-dividend day. Okay. The reason the dividends affect this is because option holders, call holders in particular, do not get the dividend. Call owners do not get the dividend. You have to actually own the stock to receive the dividend. So if we remember that options are a substitute for stock, if I own a call and I want a dividend, I have to own the stock. The call isn't going to do me any good. So one thing I can do is exercise my call, take delivery of the stock, and then I get to get my dividend. So that's the other reason that dividends, that's the reason that dividends affect early exercise. And the last point I have right here is the price may or may not move by the amount of the dividend. So theoretically, if the stock's trading at $10 and we have a 25-cent dividend, everything being equal, the stock price drops by 25 cents the day of ex-dividend because that cash now has been removed from the value of the stock and paid out, so it's going to drop. In reality, does the stock actually move exactly by 25 cents? No, probably not, because there's other things driving the stock, but that's going to be embedded into the price at some level. Okay, synthetics. And we're going to bring this into synthetics here in a second. We're talking about early exercise. We always want to think in terms of synthetics, okay? And what that means is, and I'm not going to get into what the synthetics are and how they, too much. This isn't a webinar on synthetics. But we can use combinations of calls, puts, and stock to create other call, puts, and stock. So we can create a synthetic call. Okay, by buying a put and having the stock. Okay, we can create a synthetic put by buying a call and selling a stock. And again, you can do that. I use stock here as sort of my example. The reason we do that is because most of our students deal in stock. But you can do this with futures. You can do this with commodity. You can do this with anything, any underlying. You can use these synthetics. It's all the same. There's little idiosyncrasies that you have to be aware of, but effectively it's the same kind of mechanism here to create the synthetic no matter what underlying you're doing. All right, let's start with the early exercise of puts. Okay, when we think about early exercise in puts, remember we're always thinking in terms of synthetics. We're going to think in terms of the conversion. Okay, and the conversion is this. A conversion is being long a put, short a call, and long a stock. Okay, if we're going to exercise a put, we're going to think in terms of what the put holder would do. So that we're the put holder, we're long the put. The market recognizes the idea that if you're long a put, you're going to hedge that put with a long stock position. So the put is a short stock position. The stock is obviously a long stock position. Net, there's very little delta there. The call is a short delta position, and you then hedge that also with a long stock. So the conversion itself, the synthetic, a long put and a short call is a short synthetic stock. Okay, the equivalent, the algebraic equivalent, is just being outright long the stock. So it's an algebraic equal position, and if you model this out, you'll see it. It's essentially a straight line, a horizontal line. It's riskless. Riskless in the sense of the Greeks. So if I buy 10 puts, sell 10 calls at the same strike, and buy 1,000 shares of stock, I'm going to have a straight horizontal line. Okay? There's no price risk. There's no vega risk. There's no theta risk. There's no gamma risk. Okay? There's none of that risk going on. That is my conversion. That's how I want to think about that's how I want to begin when I try to think about exercising a put early. Okay, I want to think in terms of, okay, I might just be along a put. I might not be short the call in real life, and I might not be long the stock. But when I'm thinking this out, think like this. I'm long a put, I'm short a call. Okay, that's my synthetic short stock, and I'm long the stock against it. Okay, I want to determine the most economically efficient decision as to whether or not I'm going to exercise my put. That decision is going to be based upon whether or not it's going to make more sense for me to get rid of my put and then turn around and sell my theoretical shares of stock. And you'll see that in a second. Okay, so think conversion when you're thinking in terms of early exercise of puts. Even if you don't have this other stuff on it, most of you probably don't. People just may buy puts. Okay, but when you're thinking in terms of prediction, this is what you want to think about. Okay, and ultimately what we're going to determine here is it going to be cheaper for us to unwind the entire position or leave it on? Is it going to be cheaper for me to get rid of this put, exercise the put, effectively sell my long stock out, even if I don't have it, but that's going to be the decision, and then buy this call back? Okay, that's going to determine whether or not we're going to exercise this put early. So here's what we have. This is a synthetic algebra. So here's our conversion again. Long put, short call, synthetic short stock against long stock. Okay, this is our position. Again, you may not really have this, but this is how we're going to run this through our mind. Is it cheaper to close out the entire equation or leave it on until expiration? That's what we're going to try to determine. Is it going to be cheaper for us to stay in these puts, or is it going to be cheaper for us to exercise our puts? If we do that, we're going to have to close everything out. It's an equation here. So we're going to have to buy our call back, and we're going to have to sell the stock. Okay? We are going to compare the cost of the call, because that's what we're going to have to buy back. We're short the call here. Okay? Versus the interest cost, or the cost to carry, on our long stock. So in terms of this conversion, we are long stock. We have a cost of carry when we're long that stock. If that cost of carry is greater than what it will cost us to buy our call back, then we're going to exercise. Okay? To predict the exercise of the put, we're going to look at the call. And we're going to look at the interest that we pay to carry the stock until expiration, or what we call the cost to carry. Okay? If we exercise the put, we must unwind the entire equation. Again, I got to emphasize, in reality, you may not do all these. You may not be short the call. You may not be long the stock. You may not have the conversion on. Okay? But this is simply a way for us to think about the math to try to determine whether or not it's feasible or economically efficient for you to exercise your put. Or if you're short puts, you can predict and say, you know what, I'm going to get assigned here on these puts here, so be ready. Okay, high school. Think of high school algebra. If we sell the put, okay, that's the exercise, because we're long the put. Essentially, by exercising, we would effectively sell the put. Again, then we buy the call back. We'd close out the call position, and we'd sell the stock. We'd close out the stock. So it all goes away. The entire equation goes away. So again, this is the ultimate decision right here. If the cost of the call is less than the remaining cost of carry on the long stock, if that is less, we exercise. And for those of you, I made a quick reference, a quick shot of this in the first webinar, and this is Richard Simmons, for those of you that may be too young to remember this guy. He was a big exercise guru back in the 80s, I think. He must be getting old now. This is scary to look at. Let's just turn it. Anyway, so here's the unwind. Okay, here's the unwind. original position, okay, again, the conversion, long put, short call, synthetic short stock against long stock, okay, a conversion. If we decide to exercise, we're going to buy the call, so the call goes away. We're going to sell the put goes away, and we're going to sell the stock. The whole equation goes away. We've essentially closed out the entire conversion. And again, I keep bringing this up, I keep hammering this, but I don't want anybody to be confused that they have to have a conversion on in order to, you know, to do the math to figure out if there's going to be exercise on their put. This is a decision process that we're going to use to economically determine if it's economically efficient to exercise. Okay, you may not have all of this on. You may just be long the put or short the put. All right, let's do a real quick, simple example here. IBM. Say we're long 10 IBM. I just made these prices up, so I'm sure IBM's a lot. I know IBM's higher than this. IBM 10 Jan 45 puts. Okay, we're long 10 of those. Say we're long 1,000 IBM shares. Okay, and I put implied there in parentheses because you may or may not actually own the stock. And say that we're short 10 of these 145 calls. Again, implied, you may not be short the calls. Okay, but in terms of the math here, that's what we're going to look. That's how we're going to think it through. So now we got it on. We're near expiration. Okay, let's say that we assume, or we've done the math, and we know that our cost of carry, our interest cost on the long stock, is 20 cents between now and expiration. Okay, and the math on determining this cost to carry, it's pretty simple. You just take the days to expiration, divide it by, or annualize it, so it multiply by like 360, and then multiply that by your interest rate, which is probably about 0 now, or 0.5% or something, and then times the dollar outlay that you would you'd have to put out. So it's a simple interest calculation. So say it's 20 cents. Okay. So it's costing us 20 cents between now and expiration to carry that position on, because we're long the shares and we have to, you know, finance that for the next X days. Say the call's trading at 10 cents. Well, 10 cents is less than 20 cents last I checked. So therefore, if that's the case, we exercise our put. Okay? And we do that by selling the put and selling the stock. So we no longer have to pay that 20-cent finance charge anymore, because a stock that we're long, theoretically, goes away. Okay? So we exercise our put. When we exercise our put, we basically sell the stock. We put the stock to somebody else. So the put goes away. There's the long put. The long stock is now gone. That's been sold to somebody else. And we're left with a short call. We got to buy the call now. We pay 10 cents for the call. Voila, we save ourselves 10 cents. That's the decision process. Okay. Pretty straightforward. Pretty easy math. You just look at the call. So when it's getting close to expiration and you see those calls trading at, you know, 5 cents or 10 cents, and you can kind of imply and look at the math and look where the stock is trading. You can kind of do this pretty quickly after a while and make a pretty quick determination and a pretty reliable determination whether or not your put's going to get assigned. Now, nowadays, in the environment that we're in right now, which is very low interest rate, the rates are so low, the cost to carry is so low that it's not a big a deal as it is in a higher interest rate. But as rates go up again someday, you'll start to see more and more early exercises happening. Okay. Let's go to calls now. So that was puts. All right. Calls are a whole little different animal here. Calls are let me say, the only time you would exercise calls early is for dividends. There's no other economic reason ever to exercise a call. It does not mean that you will not get exercised early in some strange, just whenever. Anybody can exercise any option anytime they want if it's an American option. That goes for calls and puts. What we're talking about here is an economic, efficient reason to do it. Okay, people exercise options, for all kinds of reasons that aren't economically based. So anyway, when we're talking about early exercise of calls, we're going to talk about it from being long the call. Okay, like with the puts, we were long the put and we did the conversion. Now with calls, we're long the call. We're going to think reversal. Okay, we're going to create a synthetic again. This time we're long the call. We're going to create a synthetic long stock by being long a call, short a put. And then we're going to make that same type of equation. We're going to sell some stock. So now we're long stock and we're short stock. That's a reversal. Again, no Greek risk, no delta, no gamma, no vega, no theta. It's essentially riskless except for this interest rate issue. And we have the dividend here. So, but from the terms of perspective of the Greeks, this is a riskless trade. It's a lockdown. Now, as opposed to the put deal where we were sort of implied being long the stock, here we're short stock. When we're short stock, as we said earlier at the very, very beginning, the implication is that we have received money into our account from selling that stock, and we're going to collect interest on that. Okay, that's what we call a short stock rebate, and we can earn money on that. Okay, so when we're trying to trade and we're doing these types of trades, that's something to think about. That's something to consider into the math. In reality, most retail accounts you don't even get short stock rebates. That's more of a professional thing. And even still in this environment, again, I mean we're talking about almost zero interest rates, so it becomes kind of a moot point anyway. But think short stock rebate. Think the interest that we potentially could get from being short that stock in our account, even if you don't get it. Okay, even if you're really not short the stock, even if you're not really short the puts. Again, think in terms of this reversal when we're going through the decision process. Okay, the dividend is the key here when we're talking about calls. Okay, economically, if the dividend is greater than the short stock rebate, then we exercise. Okay, again, it's pure economic decision. If we can make more money by collecting a dividend than we're going to receive from the interest that we might collect between now and expiration on being short that stock, we're going to exercise. It's purely that kind of decision. Most, not just most retail, I put retail in here, but most everybody will exercise the day before the ex-dividend day to capture the dividend. That's just when you want to do it. The dividend is paid out on owners of record on ex-dividend day. So I need to own the stock on ex-dividend day. If I don't own the stock on ex-dividend day, I'm not going to get the dividend. So I got to make sure that's how I'm going to try to get that dividend. In the money calls only, you're going to exercise in the money calls. You're not going to, it's not like every single call on the board is going to get exercised. You're not going to exercise out of the money calls. Okay, and not every in the money call will be exercised either. Okay, it has to be enough economically for you in the money for you to do that, make that exercise. All right, let's do a quick example here. Microsoft, $27. Okay. Let's say I think this is I took this off of Reality. I think last month it paid a 23-cent dividend. Ex-dividend date is February 19th. Ceteris paribus. I use this on the other webinar too. I don't know why I insist on using this term. I got a graduate school in economics. We had a professor that used to love this term. And in economics, it's a study on trying to do analysis in a society where nothing can be held constant, but every assumption in economics is based on holding everything fixed except and changing one variable, which you can't do. So ceteris paribus means all things equal. Everything being equal, here's what will happen. Anyway, the stock will drop by 23 cents on Feb 19. Okay, everything equal, just doesn't matter. The stock will drop by 23 cents. There's that dividend amount. Okay, in reality, it's probably going to not drop exactly by 23. It might drop more, it might drop less, because you got economics involved and whatever else is going on. But that's going to come out of the equation. So let's say that the short stock rebate is 15 cents. Okay, so let's say between now and expiration, again, I'm implying that I'm short the stock. I'm implying that I'm short the stock. I'm implying that I took in money when I sold that stock, and just say that my cost of carry that I'm collecting, or my short stock rebate that I'm getting, is 15 cents between now and expiration. Okay, I'm going to receive on that credit interest on that is 15 cents. Well, I'm going to exercise, because if I'd rather get the 23 cents. I'll give up 15 to collect 23. I'm 8 cents ahead. So what's the process? I'm going to exercise my call. Okay, so I'm long the call. I put the opposite transaction down here. So I would exercise call, which is essentially selling out the call. The call goes away. I would essentially buy the stock. I'm taking delivery now of shares. Okay, so I'm taking them. So now I'm long the stock, and I'm need to cover that short put in there. Okay, so I get that, and so now I'm there you go. I've shut the entire equation down. Okay, that put is also part of it. Okay, so you want to make sure that put isn't trading more than the dividend either. Okay, so that's what you want to do. You want to exercise your call and buy your put back. Okay, it's a pretty straightforward process when you're doing the dividend. You can use the put as a proxy. Right now, if the dividend is trading 23 cents, because effectively there's no short interest paid now, it's zero. So you can look at the puts, and this is just sort of a shortcut for determining if you're going to get exercise on your call or not for dividends. You can take a look at the puts. If the put is trading less than the dividend, you would exercise. Okay, so in this particular example, when we looked at Microsoft, it was a 23-cent dividend. If the put's trading 10 cents, chances are it's going to be an exercise. Okay, and if you get and we've had plenty of times where we've had calls that were short, and we've been assigned. Not plenty of times, but there's been a few times we've been assigned. And if the dividend was, say, 50 cents, and we weren't expecting an assignment because the put's trading 70 cents, but we get assigned anyway, what we do is we turn around, we sell that put. And that put basically allows us to synthetically collect the dividend. So that's kind of a shortcut. You can also, I put in here, you can also sell the call, especially when the stock is too expensive to buy. So for example, if you're long the call only, and you got a stock that's a couple $100 or something, and it's expensive, and you may not want to spend that much to own the stock to collect the dividend, then go ahead and sell the call. Okay, what you don't want to do is just be long the call and do nothing into the next day, because remember, that stock price is going to drop, and that means the call value is going to drop too. So you're not going to get any value out of that dividend if you don't do something. So one option is for you to just turn around and sell the call the day before ex-dividend. somebody will buy those, and then they'll probably exercise for the dividend. Don't do nothing. I don't know if that's good grammar, but don't do nothing unless interest rates are high. That really points back to the short stock rebate. So obviously, in the case of the Microsoft 23-cent dividend, if your short stock rebate is 35 cents, you're not going to exercise. You'd rather collect the 35 cents than the dividend at 25 or 23. All right, in summary, early exercise on puts is pretty easy to predict. Only on American options. Obviously, we only exercise on American. We're not talking about European. Interest rates and dividends are the factors. Think like a market maker when trying to predict these things. It's all about the synthetic. So even if you're not short the call or short the put or whatever it is, or long stock or short stock, try to think in terms of that synthetic when you're doing the math, and pretty soon it'll just sort of come automatic. Deltas generally will tell us anyway. Usually when the delta, you're not going to get exercise or sign with a delta less than 90, generally 95 or higher. In fact, 90 is probably too low. Probably need to go up over 95 before you even have to think about it. And I do mention this on the other one. In our program, we are often short in the money calls with certain strategies. We never really have to worry about getting exercised with the stuff that we talk about in our program, just by virtue of risk management and timed expiration and stuff like that. So that's not ever going to be an issue. And that is it. I hope that was clear. I want to apologize for if there was any confusion on the first one. I hope this was clear. If there's any further questions, if anybody has it, I know we don't have anybody on this live. I made this recording in the office, and we're going to repost it and let everyone know that it's there. But if there's any further questions, because no one could chat today, there's all my contact information. Just shoot me an email or whatever, and I'm happy to answer any question. I know this is kind of a weird subject. It gets a little heavy. This isn't the real easy stuff. So anyway, that's it. I hope that was, again, more clear. And I wish everybody good trading. Thank you.